Okay, in today's video, we're talking about the budget and what it means potentially for investors. So I want to share my screen and we're going to go through it. So I've just come to PricewaterhouseCoopers for their summary. So they're going to cap corporation tax at 25%, which is more than a lot of the countries in the EU. This might mean that businesses may choose to move the UK potentially. Those that are here already, it's unlikely. Bigger businesses, I don't think it's kind of a massive impact. Some things haven't changed. Painting boxes, intangible assets. R&D, I don't think has changed that much. That didn't come up. So this retail, hospitality, and leisure business rates has provoked some reaction. I think smaller businesses are going to be massively impacted because there's 75% relief at the moment, but then it's going to go down to 40% relief. So that could have a big impact on really small businesses. And what does that mean to AIM investors, to investors on the FTSE 100, the FTSE 250? Basically, I think that bigger businesses are going to do better from this. This is not a Labour particular policy. I've got a book, which I might get in a moment, which shows how small businesses have declined over the last 100 years. And it's fascinating, and it's nothing to do with Labour. It's basically across the board. Governments do not like small businesses. Well, anyway, I can't seem to find the book at this particular moment, but it was called How to Survive the Slump. And it was saying how small businesses, there used to be like 20 million of them or something, 10 to 20 million. It's gone down to 5 million. I think this measure, the relief on business rates going down for small businesses, is going to decrease that number even more. There's some support to green businesses, especially zero emission cars and vehicles. Small films will get a relief. I don't think that's really related. Alternative finance tax rules for alternative finance will be amended to put certain tax consequences of alternative and conventional financing arrangements on a level playing field from 30th of October 2024. That's something to look at, actually, because I don't know if that extends into the EIS and SEIS types of finance. So we're going to copy and paste that, and we're going to have a quick look at that. The effect that the business rates is going to have and the national insurance changes as well. The national insurance rate increases are going to mean that I think there's going to be a number of potential impacts. Number one, there might be a slowdown in hiring, potentially, especially for smaller businesses. There might be an increase in hiring freelancers because freelancers are responsible for paying their own NI, national insurance contributions. That does not fall on the business because they're hiring them as a supplier. So it could be good for freelancers. But for companies that are taking on new staff, that need to take on new staff, for growth reasons or for regulatory reasons or legal reasons or other, to stay afloat or whatever, or to meet their targets or for finance hurdles and, VC type or angel investment type hurdles, they just need to hire to grow to meet their kind of targets. They may have to increase prices. What effect is that going to have? Well, number one, it could be inflationary. These could be inflationary, pro-inflationary type policies. Number two, it could mean that their sales go down because if they have to increase their cost onto the net consumers, that means sales and revenue might go down because people are price sensitive at the moment. So if they can't pass those costs on to either customers or suppliers, their sales may come down a bit. So the people that are going to benefit, the organizations and businesses and investments that will benefit from this are those that have wider margins because they're more likely to be able to swallow the national insurance changes, and it means that they won't need to pass on those costs to the end consumer, which means their market share could increase because other people in the market might have to put up prices. An example of that might be something like a Starbucks that doesn't need to necessarily put up prices, whereas the small cafe down the road, an independent cafe, might have to put up prices. That means that they get less sales potentially, and maybe they have to there'll be an impact on their revenue. And number two, the stamp duty and the business rate, sorry, that's going to massively impact small businesses. So I think it's going to be a double whammy for small independent retail businesses, 100%. I think that's going to be very difficult. It's going to be good for businesses that are competing with those independents. So franchise companies like Catebox and other rollout stores like Starbucks or Costa, they may actually have a boon in this market. Maybe even Premier Inn might do quite well from this, because independent hotels might struggle as well with the business rates, with national insurance, with falling demand, with passing on the cost to consumers. So I think the big loser from this budget is the small, medium-sized enterprises of the UK. There will be a lot less of them in 5 years than there are now. So Labour is not the friend of the small business person, I think, from this budget. So what do I think from some of the stocks that I talk about on this channel? Well, I'll talk about some of them now. So how is this going to impact Catebox, a stock that I particularly like? I think it has good long-term prospects. I think it's going to increase Catebox, the potential for Catebox to acquire more properties as some of the independents close over the next 5 years. I think they'll be able to gain market share more easily. They've started a marketing fund now. That fund's only likely to increase, and that's going to increase their market share as well. So I think it's going to be net positive for Catebox, this Labour budget. But of course, the franchisees themselves may need to increase their salaries of their staff and will have rates. I don't know what Catebox are going to do about that. Are they going to create a fund for the franchisees to draw upon, or are the franchisees just going to have to swallow that? That's something kind of TBC. We may find out in the future what happens for franchise businesses like Catebox. Moving on to XP Factory, they're the guys that produce Battle Boom Bars, or Boom Battle Bars rather, and Escape Hunt. I think they're going to have some issues with the minimum wage and national insurance rate hikes. I don't know if they're going to be able to put up prices. I think the eating out and experiential retail night out industry is a bit price sensitive. I don't know if you can just up prices by 10, 20% and people be okay with that. So I think they probably won't be able to pass on costs of the actual entertainment, of the food and drinks. Maybe they might be able to. So maybe I think that'll be interesting. The business rates will probably hurt them quite a bit. So I think profits could actually fall short term with XP Factory, because they're not a franchisee model anymore. They're mostly owner operated. So there'll be a one-off deduction, if you like, in profits, I suspect. And then over time, that will normalize because business rates will stay relatively static. And yes, it will normalize, but there might be a devaluation potentially in XP Factory because profits will be impacted. It's not super profitable at the moment anyway. It's massively growing, so maybe the shares won't be hit. They don't have a massive following anyway, so we can have a quick look at. I'm going to share my screen and we can have a quick look at XP Factory just to see what's going on with their shares and if they've been impacted by. Oh my. Okay, so what's happened? They've gone down 2% today. What about 5 days? 5%, month 10%. So maybe there was an expectation. They've gone down quite a bit in the last 6 months. They're down to a market cap of 18 million. That's immense. So I do think there's a lot of value in this stock. Went from 50p, nearly 50p, 45p, and they're down to almost a COVID low, which is really quite interesting. I think there's some value there. Revenue's gone up quite a bit. I've covered their videos and their financials quite a bit recently, so I'm not going to dive into it too much here. But I know that they're growing. I don't see them going under, but their valuation is quite attractive. Catebox have just released their interim results, I believe, and they've done quite well. I'm going to do a whole video about that, so I'm going to stop sharing my screen now. Will be a video about Catebox results soon. Some of the other stocks I've mentioned on this show, Wise is a fintech, and I don't see this having any impact on them, to be honest. They're more globally diverse than some of the UK AIM stocks, so I don't think it's really going to have any impact on them. I don't think. As I mentioned, Premier Inn I haven't covered, but I do like the stock. It's not advice; it's just my opinion. And I think I would expect it'd be a one-off knock to earnings of a company like Premier Inn. However, I think there's room for them on pricing potentially because they're kind of well liked amongst the UK consumer base, and I think independent hotels are going to struggle. And there's been a crackdown on short-term accommodation is going to get regulated, and that's going to go much more quiet in the next 5 years. And who's going to benefit from that? Well, I think Premier Inn are going to benefit from it. So I think that's an interesting take. I've covered banks. They've done spectacularly well, kind of as I predicted. Unfortunately, I was a bit spooked last year by Nigel Farage attacking NatWest and the CEO getting fired. Since then, banks have absolutely rocketed. And I think banks are going to do well over the next 5 years. Interest rates have now been predicted at staying above 3.5% rather than going below it, which they were before the budget. And I think that's going to impact banks in a positive way. They talk about something called net interest margin, which is basically the margin on what they lend versus what they borrow themselves. And I think it's going to benefit the UK banks. In terms of some of the other stocks I cover that I haven't talked about, oil and gas, I'm interested in LNG, which is liquefied natural gas, as the reserve energy source for the UK. It's one of my thesis or hypotheses over the next 10 years. And I don't think it's going to, I don't think this particular budget is going to impact them too much. They're in, these types of companies, like New Fortress Energy, that's actually listed in the US. They're not really going to be impacted by these policies in any way. I think it really hits the small companies more than anything, which is really sad. But it's the case that every government, including the Conservative government over the last decade, crushed small businesses and small property investors. Labour's not helping either. So that's my take. It's only a short take, and I'm obviously not covering the whole of the market. But I do think that big players in the retail and leisure space will probably do well, and smaller players will probably be impacted. Those with large margins are likely to benefit. Those with tighter margins are likely to logically lose out as they're not able to pass on the costs, and they may struggle. So that's my initial thoughts on the UK budget. I may also do a video on the presidential election of the USA and how that could impact the economy and stocks. Hope you've enjoyed this. If you have, check out my other videos. I've got videos on angel investing and equity investing, a little bit on property as well. I get involved in all of those spaces when I've got capital, when I've got cash. So yeah, check out my other videos. Remember that knowledge is power, especially the right kind of knowledge, and progress is everything. I'll see you guys in the next upcoming video. Take care.